William Morris, now you have the floor.
Thank you very much, Veronica, and thank you very much, all of you, for inviting me and for attending this this great conference. I hope that one conference doesn't make a tradition, but I hope you'll invite me back next year, by which time it'll be a firm tradition. So congratulations for setting this up. One of my first visits to Central and Eastern Europe was back in the very early 2000s, when I just moved back from the US, and I visited the AmCham Romania and had a very nice meeting. It struck me that at that point, the only foreign tax advisor or foreign tax representative of any company in Romania was from Philip Morris, but the economy has expanded since then. So it's great to be back and to be involved. So look, Anthony gave a great introduction to this, and I'm not an economist. That doesn't stop me sometimes from trying, but I just want to touch on one or two of the points because they're a very important background, in particular to the way that the EU thinks about this, and that is an important context. I'll talk about digital, which Anthony touched on as well. But I know that you have a panel on that as well, so I'm not going to talk too much about it. But I do just want to talk about some of the background, which is important because Anthony has talked about some of the macro stuff. But I want to talk about how tax policy has developed over the past 10 or 15 years, and importantly, how tax policy has become a topic of public interest in a way that I don't really think it ever was before. And that has meant that the political pressures in tax policy making have increased dramatically. To be sure, tax policy in the end has always been about money. It's been about raising money for governments to spend, and that has meant that tax policy is never a dry academic subject which can be practiced from the top of an ivory tower. There's always been an element of politics in it, but that has really increased dramatically since the financial crisis, since the Great Recession, and that has increased the importance of multinational taxes. You can take this back probably to the late 80s, to the late 70s, the beginning of the 80s, and what we now view as the start of globalization, in particular, the removal of capital controls and the ability of capital to flow freely across borders. That enabled investment to flow much more freely. It enabled corporations to globalize. At the same time, taken with trends such as digitalization, which means that in 30 or 40 years, these are very, very rough numbers. The average balance sheet of a corporation has moved from being 80 or 90% tangible assets and 10 to 20% intangible property, intellectual property, to being to being the inverse in many cases. And obviously, the portability, the mobility of IP, and also the ability to do business remotely have presented challenges to tax rules, and have also presented opportunities for businesses to engage in tax planning. One of the things which changed, and I mentioned it already, and Anthony referred to it as well, is the global financial crisis, and what that did in terms of the impact on government revenues, but also what it did in terms of the impact of the views of populations about globalization, about large corporations, about governments for that matter, and this increased interest in tax. And the emphasis, a growing emphasis on fair taxation, also linked again to the other issues that Anthony mentioned, concern about climate, which has led to increased interest in green taxes. One thing that I would say about what we need to be thinking about in terms of the next couple of years is that in many ways we are still in the acute phase of this crisis. Of the COVID-19 crisis. We're still at the point where governments are trying to keep the virus under control, obviously to work towards vaccines, to keep companies, businesses propped up, in that expectation, as Anthony said, that there will be some type of a bounce back at some point. But equally, we're beginning to see the end of government's abilities, or maybe their patience, I don't know, a mix of the two, to finance all of these measures, and the withdrawal of that is going to, particularly hopefully as we move towards a vaccine, is going to move us out of the acute phase, but into the chronic phase. And in addition to all of the other points, that the macro points that Anthony mentioned, a couple of slightly more micro ones are firstly that people have been talking about a K-shaped recovery. And Anthony said that, in Europe and in the US for that matter, where I am, there are many people who have the ability to work from home. That's true. But even in Europe, there are plenty of people who do not have the ability to work from home. Those are in the service industries. And clearly, as you go towards developing countries, that becomes more and more true. So the questions which have swirled around for the past 10 years about inequality are not going to go away. In fact, they're going to get more pronounced. And that is going to have an impact on tax policy, on all sorts of policy, but on tax policy. The other is that even though a lot of companies so far have been kept going with government support, there appears to be quite a lot of evidence that in terms of cash flow and in terms of the strength of their balance sheets, these companies are greatly diminished. Their ability to plan out into the future, to grow employment, are all going to be hampered by the fact that they simply don't have the assets that they had before. And that is going to make the economy much slower. At the same time, again, while, as Anthony said, because of the automatic stabilizers, this doesn't show up in countries' accounts in quite the same way. A staggering amount of money has still been spent by governments over the past 6 months and will need to be spent by governments. And while interest rates are historically low, so this can be piled onto debt, there is going to be pressure, and we see this at the EU level. Eventually, I'll get around to talking to my slides, I promise you, Veronica. But we see this also at the EU level, but some of that is going to have to be recouped through the tax system. So there is that pressure is going to emerge. The other thing is, we cannot tell at the moment exactly how this is going to play out. But again, if the financial crisis is any indication of this, it wasn't in the acute phase of the crisis that public anger really began to drive policy. At that point, people were pulling together. It was in the chronic phase as budget cuts arose, as it appeared that to use sort of the well-worn phrases of the time, not a single banker had spent a single night in prison, all of that type of stuff, that the anger really began to influence policy. And I was just looking it up to check my dates. But the movement, the Occupy Wall Street movement, which obviously spread to Occupy London and all sorts of other places, that expression of public anger took place almost to the day, or started almost to the day, 2 years after Lehman Brothers collapsed. It took 2 years for the anger to build to a level where people went out on the streets. I actually think we're likely to see that a little sooner this time, in part because it's so close to the last crisis. But again, that is going to dramatically influence public policy, and all of the statements that businesses make, and indeed that economists make, about the need for investment, about the need for stable tax policy, are going to come up against this public anger. Okay, so that's the background, probably taking up all the time that I was meant to have. That's the background on the slides that I'm now going to go through very, very quickly, I promise. So if you could put those back up. Thanks. So if we go on to the first slide, I'm going to talk a little about what the EU has done, and the first is actually a non-tax measure, which is about the waiver of state aid rules. And obviously, as we're talking about immediate responses to the crisis, and as I say, I think we're still in the chronic phase of this, in the acute phase of this. Waiving some of the state aid rules was obviously an important thing to do. This is not a tax issue as such, but it is intimately related to tax issues because of the way that public support can be delivered. So if we go on to the next slide. talking a little about the recovery plan. No, go back a slide, please. There we go. So the recovery plan, the Next Generation EU, has this 750 billion euro fund, 390 of that in grants, 360 of it in loans. Again, there's a sort of tax funding issue lurking in the background of this. But again, you know, this is some idea of the quantums that are going to need to be spent. Now, you know, a lot of this is going to be sensible investment. A lot of this will go into green investment in particular. And, you know, over time, that will produce results. It won't produce immediate results. And, you know, there are in place measures in the EU not to have to collect on this money until late into the 2020s. So there isn't, again, an immediate tax need here. But this will, if nothing else, increase the perception that the taxes need to be raised, particularly on those who can afford to pay it. And obviously that, in a sense, is a subjective measure. But at the same time, we heard this last week, late last week, coming out of the informal ECOFIN in Germany. We heard it again in the Parliament yesterday. We've heard it in various speeches by commissioners, including Commissioner Breton. We've heard it from the French finance minister, that this particularly means digital companies, companies which are perceived, in quotation marks, to have done well out of the crisis. And that is going to be a pressure point. So we need to bear that in mind. In terms of own resources, which is going to be the method to pay back these funds, there are essentially four things that they've talked about. There's a non-recycled plastic waste. That's a relatively minor thing. Obviously, it fits in with the green agenda, with the Green New Deal. A carbon-based adjustment and digital levies. Again, these are slated for the beginning of 2023, and we don't fully have the details, certainly on the digital levy. And I have a couple of slides which go into this a little more. Sort of rebooting of the emissions trading scheme, which again is somewhere between a tax and not a tax. And then various other things, a corporate levy, the shape of which is unclear, but certainly as it's been talked about, is not a net income tax, not a tax on profits as such, but could actually be a tax on gross revenue. And there are all sorts of economic problems with taxes on gross revenue, but nevertheless, that also reflects the direction taken in the digital services tax. So with the carbon border adjustment measure, again, I'm not going to go into this in any detail. Certainly, you know, the old energy tax directive really is now quite old and doesn't cover all of the things that policymakers would now like it to cover. At the same time, it is contentious inside the EU, in particular because of, for example, the interest that Poland has in coal. We don't expect anything until later this year, earlier next year, and indeed, perhaps the change in commissioners may have some impact on this, although I doubt it. You know, it does have to apply in a non-discriminatory manner. We go on to the next slide, please. As I say, the Energy Tax Directive review, the Energy Tax Directive is quite old. This would look at how it could be updated, how it could now apply to climate change. You may have seen an announcement out of Brussels, I think by the Commission President, Mrs. von der Leyen, about the Commission increasing its goal on emissions from a 40% reduction to a 55% reduction. I think by 2030, which is, you know, quite a significant increase. Again, these rules will have to pay some attention to this. There is also, and this is you know, again, more of not quite a philosophical question, maybe a macro question. You know, there are concerns that some of the taxes which are around have already topped out, and therefore there is a very strong incentive to use new taxes, particularly these green taxes, to raise additional revenue rather than trying to get, you know, a few more points out of the corporate income tax, or indeed to continue to raise VATs. I think there are some countries which feel that the 20 to 25% range is about as high as they can go. So there will be a lot of pressure to raise energy taxes. And there are some interesting indications that business is beginning to get behind this as well. Again, from the US, there's a very influential business group called the Business Roundtable. And yesterday, they came out in favor of some type of carbon pricing, whether it turns out to be a carbon tax as such, or some type of ETS, or indeed some other mechanism. They weren't completely clear, but the fact that an organization like BRT can swing behind that does mean that that I think we may see something here. Okay, if we could move on to the next slide, please. I want to talk just a little about the OECD because I'm also involved with the OECD. And the OECD, while not a legislative body like the European Commission, does have the ability to put out recommendations. It is a sort of key standard setter. And they have put out a number of important recommendations, which many countries have followed, on how to respond to the immediate COVID-19 crisis, and indeed how to go beyond that. So in addition to the work that Anthony was talking about, that the fund have done, also, they have been tracking this. They've been doing analyses. They've worked with tax administrators, which has been very important to give practical, and Anders will know about this, to give practical advice to tax authorities on, suspending certain types of activities, extending deadlines, working on business continuity. There has also been work on transfer pricing, for example. What do you do with transfer pricing during the crisis when the comparables, for example, on amounts paid to distributors, should there be loss sharing, for example? Can the comparables reduce the cost plus return under certain circumstances down to zero, even below zero? So again, work at the OECD there to help businesses, with their taxes in this crisis year. And also an important recommendation not to raise taxes too early, sorry, typo there, 200 early, which could stall recovery, but certainly in the medium to long term, the OECD has said that those will need to be part of the fiscal mix. Again, if we go on to the next slide, these are some of the short-term measures that I was talking about, obvious ones that many governments have done. Filing extensions, payment deferrals, just basically not adding further pressure to businesses when they're already trying to deal with so many other crises. With business liquidity, loan guarantees, expanded loss carrybacks, all of those types of things. And again, query whether these are covered by, at least in the case of smaller companies, by that state aid exception as well that I mentioned right at the beginning. And then households, direct income support, again, as Anthony was saying, some of these, whether it's certainly in terms of unemployment benefits, obviously exist as automatic stabilizers in many countries, but not in others. Lowered in VAT and import duties. So, again, a lot of things done to prevent the crisis from, at least a tax, the general tax regulations, the administration of tax from applying too broadly. Then if we go on to the next page, there are just a couple of examples from countries. So I picked 3 EU countries. So corporate income tax, expanded loss carrybacks, so enabling people to take advantage of their losses to carry them back against future years, which effectively means getting refunds. Not just not having to pay taxes, but also in many cases getting refunds. VAT, deferral of payments to the end of the year in certain cases, and with social security taxes, social security contributions, reimbursements in the case of workers on reduced hours. And these obviously complement furlough payments to enable businesses to keep people on their books, even if they haven't been working. Go on to the next one, which is France. Again, not dissimilar, but slightly different in some respects. VAT reduction on rates on certain types of products, in this case, personal protection equipment and those types, that type of stuff. Again, with social security taxes aimed at the SME side of the ledger. But again, a number of options here to, and particularly in France, this is important because the so-called tax wedge is so large. And then other types of benefits, creation of a solidarity fund for smaller companies to enable those to stay alive. And then one final set of examples from Poland, I think, or slightly closer to home. Thanks. So again, on VAT, a postponement of new rates in this case by 3 months. CIT, again, essentially allowing a carryback into 2019. Some provisions for municipalities on property taxes, and administrative ones again on extending the timelines. So you begin to see in all of this, a pattern that emerges. So I've talked, although in a sense in a reverse order, about what responses to the crisis might be. In the short term, it's about taking the pressure off businesses. It's about doing whatever you can to remove some of that burden in order to allow businesses to freely deal with the very real burden, which is, reduced sales, the reduced ability to sell into any markets, how to, keep employees on the roll and employed. And then in the medium to long term, how is it that you think about financing the crisis? But also, are there other things to do to meet other factors which are out there? The climate change that Anthony talked about at the beginning, and some of the things we've talked about here in relation to carbon pricing, to the energy tax directive, to the emissions trading scheme. But also digital, which I haven't really talked about, and which I'm now not going to talk about because I really have talked for too long. But again, increasing digitalization, more and more emphasis on intellectual property, the ability to do business remotely, means that taxation on digital, and in particular taxation on companies which are perceived to have done very well out of the crisis, is going to become one of the dominant themes of the next few years. So there we are, having run way over. Let me put myself on mute, but thank you all very much.